Do you know the management team of a company can manipulate its financial numbers to make them look better? Let's see how you can spot these manipulations. Hey guys, welcome to my channel Investing Untangled. Hope you're all doing well. On this channel, I post videos about stock market research and detailed stock analysis, and also educational videos about stock market investment. And if this is something that interests you, hit the subscribe button and the notification bell and follow my content here. Management teams of publicly traded companies are under immense pressure to keep taking steps that improves the stock price so that the stock is going up, the market cap is increasing, there are more and more investors that are interested in buying the stock. So what this can lead to sometimes is that if the management is dishonest, they can actually start manipulating financial numbers and they can start inflating them so that they look much better than they actually are. And this is not good for us investors because you don't want to be involved in companies where the management team is dishonest. Sooner or later, this news comes out and that tanks the stock price quite massively and you lose a lot of money. In this video, I'll discuss some key points that will enable you to spot financial manipulation in the financial documents. You should integrate these points into your stock analysis process before you invest in a company. So let's take a look at what these key indicators are. The first indicator of financial manipulation is that the company shows growing sales when actually the sector is struggling and other competitors are struggling. So you can look at sales in the income statement of a company, and if it is showing increased sales across different quarters and different years, while there is a total slump in that sector, that suggests that the company is actually somehow exaggerating these sales. So when you want to spot this financial manipulation, you should always compare sales of the company that you are analyzing in relation to other competitors in that sector. Another indicator is a sudden surge in sales accompanied with a sudden drop in inventory. And this is very typical of many companies doing this to sort of exaggerate their sales and to inflate their numbers. And I'll show you how you can spot this. So if you go to the income statement of a company, for example, I'm checking the income statement of Nike here, and you see that in the last quarter, Nike had $11 billion of revenue. And suddenly you see Nike making double of these revenues in just a couple of quarters. You should go into details of what is going on. And one of the ways of looking at that is checking their inventory. So if you go to their balance sheet, so this is the balance sheet of Nike here, and you can look at their inventory here in the assets, and here you see Nike had $6 billion worth of inventory. And when you spot a huge surge in sales in one particular quarter or 2 quarters, and that is accompanied by a sudden drop in inventory, that should ring alarm bells. Many companies do that to manipulate and inflate their sales and make them look much better than they actually are. And in financial language, it is called channel stuffing. And if you look at what that is, here's an example. So for example, a manufacturer makes a large shipment to a distributor at the end of a quarter and records the shipment as sales. But the distributor has the right to return any unsold merchandise because the goods can be returned and are not guaranteed as a sale. The manufacturer should keep the products classified as a type of inventory until the distributor has sold the product. But what companies do is they will send this off to the distributor and register these as sales already and show them in their income statement. And there will be a corresponding drop in their inventory. Another thing we should be careful about is a sharp increase in inventory, and it can be mistaken for an increase in total assets and thereby shareholders' equity. Let me go to Nike's balance sheet again to explain to you what I mean with that. So here is the balance sheet of Nike again, and in the assets you see these inventories here. And if there is a sudden increase in inventories, that will eventually lead to an increase in total assets because it all is added up as assets. And if you're just looking at total assets as part of your analysis, you will see that Nike has been increasing its assets, which is a positive thing, and this will make it attractive for you as an investor. But then if you dig deeper, you will realize that it is just a massive accumulation of inventory, which can mean that Nike is actually not able to sell its products, and that's what is leading to this accumulation of inventory. And later on, they might have to sell these inventories on a discount price, which will reduce their current assets and also reduce their revenues. And an increase in inventories can fool us as investors in another way, because as I told you, it gets added up into total assets. That means total assets increase, and total assets minus total liabilities is equal to shareholders' equity, which is given here at the bottom. And if there is an increase in assets, that means there will be an increase in shareholders' equity, which is actually good for investors. We look at these values like assets and shareholders' equity, and if these things are growing, that is positive. But you should see why it is growing, and if there is a sudden surge, what is the reason? And this is one of the ways you can spot it. You can look at the inventory, and if there is a massive increase in inventory, which is actually a negative sign, that can increase the assets and also inflate shareholders' equity. The next indicator for us is a very high load of intangible assets and goodwill relative to the total assets of a company. So let's again go to the balance sheet of Nike here, and I'll show you what I mean with that. So here again is the balance sheet of Nike, and these are the assets, and intangible assets will be right here in the assets category, and you will see that Nike has $270 million worth of intangible assets, and under that there is goodwill. So intangible assets are assets that cannot have a value. You cannot put a price tag on them. It's something like brand image, etc. So they're not like real tangible assets. So if a company is liquidated, these assets will basically not bring in any money. So whenever you're looking at total assets, you should actually see how much is the contribution of these intangible assets to the total assets. The same with goodwill. So goodwill is if Nike, let's say, buys a smaller company, it acquires a smaller company, and the value for that is $10 million, let's say, and Nike pays $15 million. And that extra $5 million is registered as goodwill. And companies often do it because they feel like they're buying the brand of that smaller company. They're acquiring all the workforce from them. So sometimes they pay extra and register that as goodwill. But if you think about that, goodwill is also not going to translate as actual assets. That's why whenever you look at total assets, you should see what is the total contribution of intangibles and goodwill in that. The total assets for Nike are right now $34.8 billion, and if let's say $20 billion out of these 34.8 would be intangible assets and goodwill, I would be actually a little bit uncomfortable with that, because that means these are not real assets and the company is registering them as real assets, and this gives a false impression to the shareholders. So this is also something that you should keep in mind when you're analyzing a company. Always look at intangible assets and goodwill in relation to total assets. Okay, moving on, the next indicator is an unusual increase in return on equity, which can be due to reduced shareholders' equity. And I'll explain to you this in detail. So for understanding this concept here, you should know that shareholders' equity is equal to total assets minus total liabilities that I showed to you before using Nike's balance sheet. So let's consider a company where the shareholders' equity is $10,000 and it makes a net income of $1,000. So the return on equity, which is also ROE, and it's always given as a percentage, it will be net income divided by shareholders' equity times 100. So this is the formula for calculating return on equity. And in this case, it will be $1,000 divided by $10,000 of equity times 100 is 10%. Now consider a new scenario here. The company spends $2,000 to buy back its own shares, and cash is counted into total assets. That means the company now spent $2,000 and shareholders' equity will drop by $2,000, so it goes down to $8,000. And let's say the net income remains the same of $1,000, and suddenly you'll see the return on equity, which will be now $1,000 divided by $8,000 of this equity here times 100 will be 12.5. So suddenly you see ROE looks much better than what it actually was before. But the company didn't make any more money. If you would just look at the number, you would think that the company actually made more money, but the net income is the same. It's just that the equity went down. So companies can play around financially using this metric they can actually spend money to invest in other businesses or to buy back their own shares. That reduces their equity, and a reduction in equity means there are more returns. So ROE increases, return on equity increases, and a lot of investors like us are always looking at returns on equity, and if the returns on equity are great, are high, that is a very positive sign for the company, and investors are attracted to these kind of companies. So here you can see, to impress investors, companies can actually artificially increase their returns on equity. And what you can do to counter this manipulation is that as investors, you should always look at return on equity and also at return on invested capital. What return on invested capital does is it actually includes not only the shareholders' equity in the formula, but it also considers the debt the company has. So if both return on equity and return on invested capital are increasing by similar margins, going in the same direction, that is always a positive sign that the company is doing well, it is getting great returns, and there doesn't seem to be any manipulation. And you don't have to calculate these numbers yourself. If you go to the Morningstar website and go to Nike page, and you will get all these key ratios, and at the end you will get the profitability ratios where both these will be calculated for you. So return on equity percentage and return on invested capital percentage. And for Nike, you can see that this company actually earns really high returns on both equity and invested capital, and this is a very positive sign. And the final indicator that I'm going to tell you about is when a company is inappropriately capitalizing its regular expenses. And what that means is when a company is showing that its expenses are lower than they actually are, that will automatically increase its income. Now I'll explain to you what capitalizing an expense means. Let's consider a hypothetical situation again where company A has a production expense of $10,000, meaning whatever product it is making, it uses $10,000 to make that product, and that's an expense. And this expense will be expensed out or deducted from its operating cash flow. And operating cash flow number you can find in the cash flow statement of a company. So let's say the operating cash flow was X, and it had this production expense, and now it is X minus $10,000. And now if the company capitalizes this expense, so instead of reporting it as a production related expense, it will be moved to the investing cash flow section, which is also one section in the cash flow statement. I'll show you these different sections in a minute. So in this case, what happens is operating cash flow remains X because this $10,000 has been moved to investing cash flow because this expense, which was originally related to production, has been capitalized. And what capitalized expense is, it basically means that it will be expensed out over time. It doesn't go out in bulk at one point. So what the company does is it actually shows this loss of $10,000 gradually across different years. So here you can see it can show from 2021 to 2025 a depreciation of $2,000 each year, amounting to a total expense of $10,000. And investors are always looking at this number, operating cash flow. If a company reports strong operating cash flow, they're always attracted to this company. So here you can see how a company can manipulate its expense. Instead of expensing it out as a production expense, which will reduce its operating cash flow, it throws it in the investing cash flow section where this whole $10,000 will be going out in chunks, so it doesn't look like a massive sum is going out of the cash flows. So here's again what the capitalization of an expense means. The costs of production come out of the net income and therefore operating cash flow, as I told you. But instead of taking the hit of an expense all at once, companies capitalize the expense, creating an asset on the balance sheet in order to spread the expense out over time, meaning the company can write off the costs gradually. So it doesn't go out in one chunk, but it is gradually expensed out, and that doesn't look that bad for cash flows. And now if you look at the cash flow statement of Nike right here, so this is where the operating cash flows are reported. So cash provided by operations. And the final cash flows from operations are right here at the bottom. So in this case that I told you, what a company would do is if an expense is related to the production of its product, it would, rather than reporting it in the operating section, it would throw it in the investing section right here, where generally investors do not spend a lot of time looking at these numbers. So that paints a rosy picture for the company. And a classic example of this was when AOL, this company, capitalized its expenses in 1990s, and it was charged for that. And here you can see AOL was charged with engaging in various acts of security fraud. And what they did was they actually moved these advertising expenses associated with these CDs as capital expenses rather than as regular expenses. And this presented a false picture of the company's profitability and boosted the stock price. And when you suspect something like this, you should read the footnotes of the cash flow statement and see what is being expensed as, as a capital expense. And would that actually genuinely belong to a capital expense, or would it be a regular expense? And this is how you can spot it then. And finally, I'll talk about two ratios that you can look at to figure out how financially stable a company is and if it is a manipulator or not. The first one is the Beneish model, which is a mathematical model that uses financial ratios and 8 variables to identify whether a company has manipulated its earnings. It is used as a tool to uncover financial fraud. And using all these variables, this model comes up with an M score, and an M score of less than -1.78 suggests that the company will not be a manipulator, and an M score of greater than -1.78 signals that the company is likely to be a manipulator. And if you go to gurufocus.com, this website already calculates this M score for you. I'm on the Facebook stock page of Guru Focus, and here you can see in the financial strength section, it already calculates this Beneish M score for you. And here you see it is -2.44, and it says that it is not a manipulator. The other one that I look at is this Altman Z-score, and what that is the output of a credit strength test that gauges a publicly traded manufacturing company's likelihood of bankruptcy. So this is more inclined towards understanding how financially stable this company is and how solvent this company is. And here on Guru Focus, you see that with the Altman score for Facebook, it is very safe. And when the score moves to gray or distress, that's when it indicates that the company might not be financially stable. So these are all the indicators that I have actually integrated into my stock analysis and stock research. And before investing in any company, I basically go through all these points that I mentioned in this video. I hope you got some useful information out of this video. Please consider leaving a like and subscribe to this channel, Investing Untangled. I'll be bringing in more informational videos like this and also detailed business and stock analysis. So stay tuned to my channel, and I'll see you in my next video.